Welcome to Business with Louis, the show where we break down complex business concepts into actionable insights that you can use to grow your career or venture. I'm your host, Louis Riskwiser, and today we're diving into a topic that's not only crucial for the future of our planet, but also increasingly important for the bottom line of businesses around the world: ESG investing. So, what is ESG investing? Simply put, ESG investing is an approach to investing that considers environmental, social, and governance factors in addition to traditional financial metrics. It's about recognizing that a company's long-term success is not just about its profits, but also about its impact on the environment, its treatment of employees and customers, and its commitment to transparency and accountability. The concept of ESG investing has been around for several decades, but it's gained significant traction in recent years as investors, consumers, and regulators have become more aware of the importance of sustainability and social responsibility. In fact, a report by the Global Sustainable Investment Alliance found that sustainable investing assets reached $30 trillion in 2020, up from $22 trillion in 2016. But why is ESG investing important in the world of business and entrepreneurship? For one, it can help companies mitigate risks associated with environmental degradation, social unrest, and poor governance. It can also help them capitalize on opportunities related to sustainable development, such as the growth of renewable energy and green technologies. Moreover, ESG investing can provide a competitive advantage by enhancing a company's reputation, attracting top talent, and improving its relationships with stakeholders. The E in ESG stands for environmental factors, such as climate change, pollution, and resource depletion. Companies that prioritize environmental sustainability are more likely to reduce their carbon footprint, conserve natural resources, and minimize waste. For example, companies like Patagonia and REI have made significant investments in sustainable supply chains and renewable energy, which has not only reduced their environmental impact but also enhanced their brand reputation. The S in ESG stands for social factors, such as labor practices, human rights, and community engagement. Companies that prioritize social responsibility are more likely to treat their employees with dignity and respect, promote diversity and inclusion, and engage with local communities. For instance, companies like Microsoft and Salesforce have implemented robust diversity and inclusion initiatives, which has helped them attract and retain top talent and improve their relationships with customers and stakeholders. The G in ESG stands for governance factors, such as board composition, executive compensation, and transparency and accountability. Companies that prioritize good governance are more likely to have a diverse and independent board, align executive pay with long-term performance, and provide transparent and timely disclosure of financial and non-financial information. For example, companies like Berkshire Hathaway and Johnson & Johnson have a strong track record of good governance, which has helped them build trust with investors and stakeholders. One notable example is the company Unilever, which has made significant investments in sustainable agriculture, renewable energy, and waste reduction. As a result, Unilever has not only reduced its environmental impact, but also improved its financial performance and enhanced its brand reputation. Another example is the company Tesla, which has disrupted the automotive industry with its electric vehicles and solar panels. Tesla's commitment to sustainability and innovation has helped it attract a loyal customer base, improve its brand reputation, and drive long-term growth and profitability. On the other hand, companies that neglect ESG factors can face significant backlash. Consider the example of Volkswagen, which faced a major emissions scandal in 2015. The fallout wasn't just reputational, it had a direct and devastating impact on their stock price and bottom line. Similarly, companies like ExxonMobil and BP have faced criticism for their role in climate change and environmental degradation, which has damaged their brand reputation and eroded investor trust. So, how can you apply ESG investing principles to your own business or investment strategy? First, do your research. Look for companies that not only have strong financials, but also a track record of environmental stewardship, social responsibility, and good governance. Consider using ESG ratings and reports from reputable sources like MSCI or Sustainalytics to guide your decisions. Second, think about how you can integrate ESG considerations into your own business practices, whether it's reducing waste, implementing diversity and inclusion initiatives, or enhancing transparency and accountability in your operations. Every step counts. For example, companies like Amazon and Google have made significant investments in renewable energy and sustainable infrastructure, which has not only reduced their environmental impact, but also improved their financial performance. Third, consider engaging with stakeholders, including employees, customers, and investors, to understand their ESG expectations and priorities. This can help you identify areas for improvement and develop strategies that meet the needs of all stakeholders. For instance, companies like Starbucks and Nike have established robust stakeholder engagement programs, which has helped them build trust and improve their relationships with customers and investors. Finally, remember that ESG investing is not a zero-sum game where you have to choose between doing good and doing well financially. In fact, a growing body of research suggests that companies with strong ESG performance tend to outperform their peers over the long term. A study by Harvard Business Review found that companies that prioritize ESG factors tend to have higher returns on investment, lower volatility, and better risk management. In conclusion, ESG investing is an approach to investing that considers environmental, social, and governance factors in addition to traditional financial metrics. It's about recognizing that a company's long-term success is not just about its profits, but also about its impact on the environment, its treatment of employees and customers, and its commitment to transparency and accountability. By integrating ESG considerations into your business or investment strategy, you can mitigate risks, capitalize on opportunities, and drive long-term growth and profitability. Thank you for joining me, and I hope you found this conversation informative and insightful. Like, share, and subscribe, and remember, every great business starts with action. Make your next move count.